Hi everyone, I'm Rahul Kolte from Aditya Birla MyUniverse. I extend a warm welcome to all our viewers who have joined us for this webinar titled ELSS Sahi Hai. The objective of today's webinar is to help you make an informed decision on tax-saving investments like Equity Linked Savings Scheme or ELSS as it's called popularly. I have with me our expert Mr. Satish Prabhu from Franklin Templeton Mutual Fund. Satish will help us explain various facets of equity linked savings scheme. I will also take a couple of questions which you have asked during the registrations as we go through the webinar. So let's get started. The first question that Satish that I would like to ask you is, many individuals attempt to invest under Section 80C to save tax. Can you give a brief overview on what is Section 80C?
So Section 80C is one of the most popular sections in the Income Tax Act as far as investments are concerned. So though you have many other things that go into Section 80C, like your child's tuition fee can be claimed in Section 80C. You can claim the principal that you repay as part of your housing loan under Section 80C. But when you talk about pure investments, I would bifurcate that into two parts. One is products which give you assured returns, or the traditional products, and the second is the newer products which have market-linked returns. So when you come to traditional products, you have typically the bank fixed deposits, you have your public provident fund, you have national savings certificates or the postal savings, and you also have the EPF, which is deducted from salaries and goes as provident fund into the EPFO. Coming to the market-linked investments, you have equity-linked savings schemes or ELSS, which are offered by mutual funds, and you have ULIPs, which is unit-linked insurance plans offered by insurance companies. Now, this is an overview of products. Now, the unique aspect about Section 80C is each of these products also has a lock-in period.
Yeah.
Now, if you look at, say, a PPF, it has got a 15-year lock-in period. If you look at the National Savings Certificate, it has got a 5-year lock-in period. Your bank FDs have got a 5-year lock-in period. Coming to ELSS, it has got a 3-year lock-in period. ULIPs have a 5-year lock-in period. So among all these products, if you look at it, ELSS has got a relatively lower lock-in period of 3 years. The third part is the investment amount. So under Section 80C, you are allowed to invest up to 1,50,000 every year into one or many of these products. You can divide your money and invest across these products.
Yeah.
And the fourth part is how much tax can you save?
Yeah.
Now, if you invest 1,50,000, the amount of tax that you save is based on your tax slab.
Right.
Now, somebody who falls in the highest tax slab of 30% can save 1,50,000 into 30%, which is around 45,000 plus some education cess. So that is the amount that one saves if he's in the 30% tax slab. If somebody is in the 20% tax slab, the individual can save around 30,000 plus education cess. The important point is that it is very important that people should invest in Section 80C, not only to save this tax. Of course, if you don't save, then this tax goes from your kitty. But what also happens is when you invest, you also get the returns.
Yeah.
So you benefit in two ways. You save tax, plus you also earn returns on these investments. So that's, I believe, a broad overview of Section 80C.
That's very well said, Satish. So Satish, when customer generally ask us, while Section 80C is giving you a tax saving benefit, but there is always a discussion around whether to invest in a traditional option like fixed deposit or whether to go for market linked product like ELSS or ULIP. So can you elaborate on this?
So I think it's a good question, and this is a query in most of the investors' mind, like whether should I go for a traditional option or whether I should go for an ELSS. So let me go back to history. If you look at the 90s, typically the interest rate in the 90s were pretty high, and people were getting 12 to 14% returns from traditional products.
Yeah.
So at that time, there was no need to look at any other product. People were happy with 12 and 14, and most of the money was going into traditional avenues. But over the last 2.5 decades, we have seen that interest rates have fallen. And today, if you look at traditional products, the returns are somewhere in the range of 6 to 8%.
Right.
So one, the returns on traditional products have fallen. What is the other change that we are seeing is there is a lot of consumerism in the market. What was not seen in the 90s. Today you have people with a lot of aspirations. Also incomes have gone up. You have, quite a few goals that you need to achieve. And a lot of things on the consumer side can be bought very easily today. You go online, you can buy this. A lot of things that you wish to buy, like travel, like people may be traveling once a year or once in 2 years, 20 years back. Today they travel 3 to 4 times a year.
Yeah,
so all these aspirations have gone up. You need a lot of money to meet these aspirations. You need a lot of money to meet your goals. So is this possible, to generate that type of money through traditional options? I feel the answer is no. So if you invest for the multiple goals that you have and the multiple aspirations that you have with an instrument which is giving you 6 and 8%,
Yeah.
I feel the answer is no. So what is the way out? So that's why people are looking at options which can give them better returns. Better returns, I would say, over and above inflation. And that's where market-linked investments are coming into play. And if you look at history of market-linked investments, they have given you good returns over and above inflation.
Correct.
And the only point there is they don't assure you any returns. Two, there is some bit of risk. So risk and returns go hand in hand. You need to take some bit of risk, but the risk can be mitigated. So there are ways to mitigate that risk. So people should look at a combination of both options and look at their risk appetite in deciding where they should be higher. So whether it's market linked or the assured return products.
So in short, as you said, that when deciding under which option to choose, one has to look at the investment horizon.
Absolutely.
One has to look at the risk appetite that one wants to take. One also need to look at what is the minimum investment amount that he wants to start with.
Perfect.
So I think these are a couple of points, as you elaborated, that one must keep in mind while taking the LSS or the other traditional option decision.
Correct.
So coming back to one of the questions that our viewer has asked, while one of our investors has asked this query, that he has made up his mind to invest in ELSS, but he is now kind of wants to understand whether to go and invest through ELSS, whether to go and invest through SIP. The other dilemma that he is facing is whether to go for a dividend plan or whether to go for a growth plan. So can you throw some light on this?
So let me first elaborate what ELSS does. So what people are largely aware of ELSS is that it's an equity-linked, plan offered by mutual funds. They are aware that it offers a 3-year, it has a 3-year lock-in period. These are the two aspects that largely people are aware of. But they should be aware that this product has some bit of risk involved. Why do I say risk? Because it is volatile in the short term. So if people think that they can put their money today and withdraw after 3 years, I feel that they should, look a little bit deeper, because equity markets are volatile in the short run. They may fluctuate.
Okay.
There is a chance that if you put your money today in 2017 and look at a withdrawal in 2020, there could be a chance that markets may have fallen by that time. So you need to look at a longer investment horizon. You need to look at least 5 years, I would say, if not longer, to invest in ELSS. So you need to have a longer investment horizon. And again, when investing, what I have come across is that people, just rush into the product. So when you look at ELSS, so I can think about one context is that typically all salaried individuals get a mail from their payroll team, say in November.
Yeah, correct.
That they need to show their proof of investments. Many of them, run helter-skelter that I have to gather all this thing within a month's time. So they may contact a financial advisor, they may contact an agent and say that I want to invest. And those who want to invest in ELSS, they take some bulk money and just dump it into ELSS. But, God forbid, if the market, falls immediately in the short term, you may see that, I had invested, but, I'm getting lower returns than I had anticipated. So people should be aware that this is a volatile investment option. So there is a way of mitigating this volatility. There is a way of riding over this volatility, and that way is SIP, which is systematic investment plan. How does it help? It helps you basically to invest, to spread your investment across time frames. So for example, if somebody wants to invest from November till March, I would say that instead of putting all your money in November, why not spread it over till March?
Right.
A better way would be to spread it across the 12 months. So if somebody is thinking about investing 1,50,000, why not have 12,500 every month for all the 12 months?
Right.
And do it, perpetually till the time you want to, keep investing in ELSS. You could do that. So SIPs help you ride the volatility because it helps you to buy more units when the markets are down. It helps you to buy less units when the markets are up. So on an average, if you invest across market cycles, you'll find that the unit cost, it comes down. So that's a big advantage because this is typically what you do even in your personal life. If you feel that some goods are costing more, you'll buy less. Some goods, whenever they cost less, you'll try to buy more of them. So this is exactly what SIP does. And that's why SIP is a much better way of looking at ELSS than a lump sum.
But what to those who have missed the bus and have not started their ELSS SIP in April, so what would you suggest now? So there is no option for them to
so again,
really
as I
go
said,
for an SIP
yeah,
and
so I would
say
say
1.5.
that, yeah, so I would say that put that money, but if you can spread it till March, that would be a better
Every
option.
month would be a better option.
Absolutely.
Right?
So that is one way. There are another way, a thing that people are not aware is that all the returns from an ELSS are also tax-free after the lock-in period. So technically for all equity investments, after 1 year, the returns are tax-free. For ELSS, you have to wait till the lock-in period is over. And people are also not aware that every SIP installment has a 3-year lock-in period. So that is one thing that people
I think that's a good
should
point
be
that
aware,
you have made,
should be aware of, that every SIP installment has a 3-year lock-in period. You should be aware of that. And as I said earlier, don't, redeem your SIPs just because the lock-in period is over. The SIPs or the ELSS investment is more for wealth creation.
Absolutely.
Tax benefits are a supplement. It just comes along with ELSS, but the main objective of ELSS is wealth creation. So people have to look at wealth creation as as a bigger goal of ELSS than only tax saving. So even the dividends that people get from SIP, they are also tax free. So this is also one of the features. And people are also undecided of whether they should go for a growth option or a dividend option.
Yeah, that's what.
So this is what I've seen people asking whether I should go for a growth option or a dividend option. Now, a dividend option, people may say tax-free dividends, let us select that. But if you don't need the cash flows, I would say that don't take the dividend option, take a growth option. Now, cash flows in equities are never sure. So people feel that I'll get regular cash flows. That is not the case. The cash flows are totally based on, the available distributable surplus with the fund. So you'll get only cash flows if they are available. Again, market situations, etc., may decide the cash flows. So don't take a dividend option if you are not going to use those cash flows. Go for a growth option. Growth options are better when it even comes to compounding. The wealth effect can be created better if you go for the growth option than the dividend option. So between SIP and lump sum, I would say take a SIP. Between growth and dividend, if you don't need the cash flows, I would say go for the growth option.
So as you said that in a longer horizon, ELSS has the potential to really create wealth for the investors. So can you throw some light on how is the past performance of ELSS funds?
So I think this is the crux of ELSS. We always say that ELSS has the potential to provide higher returns than assured returns products. But again, it's a trade-off between risk and return. So one must be ready to take some bit of risk when they look at ELSS. So I have taken the returns of the CRISIL AMFI ELSS Fund Performance Index, which is a mix of key ELSS funds, And I have taken the SIP returns of this index over a 5, 10 and 15-year period up to November 30th. So the 5-year SIP returns were 18.86%, the 10-year SIP returns were 16.06%, and the 15-year returns were 18.27%. So the returns have varied between 16 and 18%, which are pretty good when you look at choosing ELSS. Now, if I look at Nifty 50, which is a benchmark, the returns have been 12% in the 5-year SIP, 10.9% in the 10-year SIP, and 12.91 in the 15-year SIP. So if you look at the difference, there has been a 6% difference in the returns provided by ELSS funds and the Nifty 50. So it has given a significant alpha over the benchmark. So that's one point. The second is, if I look at absolute returns, so I suppose there's an investor who looks at 10,000 rupees a month in an SIP, a 5-year period would result in 6 lakhs as the principal. The final maturity amount is 9.5 lakhs. And if you extend it to a 15-year period, the principal is 18 lakhs and the final amount on maturity is 82 lakhs. So if I take a multiple, I would say in a 15-year period, the investor has got 4.6 times, the multiple. And the same in the index would have given around 3 times the multiple. So in a way, there has been good compounding in SIPs. The returns have been, reasonably good. And as I said earlier, they are much better and over and above inflation, and definitely far better than a short return products.
So any observation, as you read out different returns for different horizon, so any observation that a longer horizon really helps investors to reduce the risk?
Absolutely. So historically, we have seen that the negative returns that any period has given comes down drastically when you look at longer investment horizons. So the negative periods may be there, say in a 5-year period, but as you move to 10 and 15 years, the negative periods almost come to nil.
So that means the probability of loss is drastically reducing as one is increasing the horizon.
Yes.
Yeah. Very well. So one of the questions that it's a very interesting question that one of the users has asked. So one of our customers has written us, say hypothetically starting his career at the age of 25, and this particular investor has a career span of 35 years, and say he's investing 1.5 lakhs every year into ELSS. How much would be his wealth at the end of 35 years? That means he's retiring at 60. How much he will take home when he retires just by doing 1.5 lakhs every year?
So I think it's a very good question, and why I say this is that typically people look at ELSS only from the point of view of tax saving. There are people who invest for 3 years, take out that money, put it back into ELSS, and then keep doing that. I feel that that's an absolutely incorrect practice, because the use of ELSS has to be more from a wealth creation perspective, exactly the way this individual has asked. So if you try to do that, over longer periods of time, you'll realize the significant wealth effect that ELSS has. And if I look at, say, the same example of investing 1.5 lakh rupees every year through an SIP, which is 12,500 every month over a 35-year period, the principal that this person puts into ELSS is 52.5 lakhs. Okay, but that he has spread over a 35-year period, so you'll not get to actually feel that it's such a big amount. But if you look at even a 12% rate of return, I'm not taking 18% because 18% may not sustain going forward. But even if I look at a very conservative estimate of 12%, the wealth built up is 8 crore.
Oh, that's amazing.
So, and look at this, ELSS is going to be only one of your investment options. At the age of 60, I'm sure you've got investments across. And if one of your investments like ELSS can give you 8 crore, think about the retirement kitty that you have. I think you will be in a much comfortable position at the age of 60 if you continue this investment rather than, looking at it only from a 3-year investment horizon. Again, why this 8 crore? So the 8 crore is because there is a compounding effect. Now compounding effect can come even in a fixed income instrument. So if I look at, say, a 6% rate of interest, the person can generate somewhere around 1.78 crore. It's much lower than 8 crore.
Significant difference.
Significant difference.
Yeah.
So the compounding effect comes because of 3 things. One, where you invest. So it depends on whether you invest in fixed income or whether you invest in market linked products like equities. Second is how long you invest. So the longer the better. So compounding effect comes with a longer period. So 35 years is a pretty long period. And the third thing is how much you invest. So you have invested 12,500. You may invest 15,000. You may have a step up by investing 10% extra every year. ELSS doesn't say that you need to invest only 1,50,000. You can invest much beyond 1,50,000. 1,50,000 is only the limit set by the income tax to claim tax benefits.
Correct.
But from a wealth creation perspective, you can look at more than one. So you can use a step up and say that I want to invest more. So how much you invest? So if you look at these 3 aspects, it helps you create a package for creating wealth. So ELSS has a significant potential to create wealth, and at the same time give you the corollary benefit of saving taxes at the same time.
So as you said, Satish, so the main objective of investing in ELSS shouldn't only be tax saving.
Correct.
It has to go in hand with wealth creation, which is always a major objective for most of the investors.
Correct.
When they save their hard-earned money and invest into various investment options. So I think as we are closing towards the closure of the webinar, one interesting thing that I have got from this particular webinar is that one need not look at only tax saving as an option, but set a goal for yourself. Set a goal, and for that goal you start investing. It doesn't matter whether you're investing in ELSS or open-ended equity fund. You're investing into for tax saving, but make your investment count by putting it into right investment instruments, have a longer horizon, have a goal, and surely, as the example said, that one can end up with 8 crores as a retirement kitty by just investing into 1.5 lakhs every year at a compounding of 12% per annum. So at the end of the webinar, any closing message that you'd like to give our viewers?
So certainly there are quite 2-3 closing messages that I would like to highlight based on what I've seen people doing. One clearly is that don't miss out on Section 80C. Section 80C is a very important way of investing and tax saving. So you get a double benefit of not only saving taxes but also investing. People should not miss out on the tax saving aspect and the investing aspects, because investing also gives you the returns. So you have a double benefit of tax saving. So do not miss out on Section 80C. The second important message is that if you think about ELSS, do not think about investing just for the sake of investing. You should plan it out in such a way that you can spread out your investments across time frames. So think about, say, the declaration that people give in April that I will invest X amount of money in these instruments. And typically I've seen that people forget about it by the time it's October or November, and suddenly it clicks that when you see that mail that, oh no, I have to invest this much. So you have missed out on the crucial compounding benefit that you could have got for that 7-8 month period. So it's very important that you should plan out your investments, start your investments well in advance in April. And if you, like the guy who's talking about a 35-year investment period, think about investing across time frames and plan from April and do a SIP, and most importantly, link your ELSS wealth to some goal.
Absolutely.
So it's very important that you link to some goal rather than putting an ad hoc investment and let it lie there. Goal planning is very, very important. So you need to link it to a goal. And third most important is be very, very consistent. Do not think about markets are down, I don't think it's going to do well. So you have invested in this instrument only for the better returns that it can provide, and this can provide better returns only if you invest for the long run. For those who are first time investors, so maybe they have not taken this type of risk before, they've not invested in equity products before. What they should do is, as I said, the minimum SIP amount is just 500 rupees a month.
Oh.
So when you talk about 500 rupees, you could just start an SIP in an ELSS with 500 or 1000 or whatever the amount that is comfortable to you. Just start that and look at how it pans out. So look at how you get comfortable with that investment. Start in small doses, and if you feel that you're comfortable, maybe in 1 year or 2 years time, just keep stepping up that investment. So I would say that it's a great opportunity even for first time investors to start investing with a very small amount and then keep increasing that amount over a longer period of time. For those who have been into ELSS in bits and pieces, clearly the message is given by the query that has come up, that you should not stop your SIP investments come what may, and just continue that for a longer period of time, because only that can help you in creating the type of wealth that we talk about when we say that people should look at mutual funds in the long run.
Thanks, Satish. So viewers, the message is very clear. You must look at ELSS not only as a tax saving option, but also a long-term investment options to create wealth. So as due to lack of time, I wouldn't be able to take all the questions. We'll have to close the webinar. Thanks, Satish, for this informative and simple session.
Thanks, Rahul.
On behalf of MyUniverse and Franklin Templeton Mutual Fund, I'd like to thank all of viewers for joining this webinar. Happy investing. So as a disclaimer, please note that mutual fund investments are subject to market risk. Read all scheme related documents carefully. Thank you very much. Please note that mutual fund investments are subject to market risk. Read all scheme related documents carefully. Thank you.